An ordinary morning in Canada. Coffee still hot, highways still crowded. Yet inside many middle-class kitchens, a sense of financial security has quietly disappeared. Income hasn't collapsed. Jobs still exists. So why are families becoming poorer? The answer isn't a dramatic crash, but slow erosion. Interest rates rose from near zero to over 5% in a short time, turning familiar mortgages into heavy burdens. Housing, once seen as a financial anchor, has stalled as market liquidity weakens. The Canadian dollar fluctuates under a strong US dollar, pushing import costs higher. Meanwhile, real wages fail to keep up with inflation, shrinking purchasing power. Global CDS indicators once early warnings of crises are edging higher again. Canada's middle class isn't poorer because of personal failure, but because it stands at the crossroads of a turning economic cycle. Economic crises rarely arrive with panic at first. They reveal themselves through subtle but widespread shifts. Household debt in Canada exceeds 180% of disposable income, among the highest in the G7. Personal savings have fallen to historic lows, while credit card debt grows faster than wages. Housing markets are fragmenting. Transactions decline, inventory reases, yet prices resist falling as sellers cling to past expectations. The real danger lies in liquidity. As banks tighten lending, money flows slow across the economy. Small and mid-sized businesses delay investment and hiring. Yield curves invert, signaling future slowdown. Middle-class families feel the crisis not through charts, but by cutting expenses, delaying children, or working longer hours to service variable rate. Debt. The economy still runs, but confidence begins to crack. To understand this shock, we must examine how cheap money reshaped behavior. For over a decade, low interest rates rewarded borrowing over saving. Families bought homes with leverage, businesses expanded on debt, governments increased spending. When inflation surged, central banks were forced to reverse course. Rapid rate hikes delivered a double shock, higher borrowing costs while asset prices lost support. Liquidity drained from the system, tightening the economy's bloodstream. This pattern is not new. It appeared in Asia in 1997 when capital reversed, in Argentina's inflation tightening cycles, and in Greece when public debt exceeded capacity. The common thread is always the same. The middle class is hit first, owning enough assets to lose and enough debt to suffer. Global comparisons reveal that Canada is not immune. The Asian financial crisis showed how households borrowing against future income collapse when capital flows reverse. Argentina demonstrates how persistent currency weakness erodes the middle class, even when nominal GDP grows. Greece lost a decade as austerity crushed incomes faster than living costs. Turkey and Venezuela show what happens when trust in currency collapses. Canada differs with a stronger financial system, but shares a dangerous similarity: expectations. When people believe housing always rises, and debt is always manageable, risk accumulates silently. Once that belief weakens, the economy continues, but society contracts inward. The impact on Canada's economy is clearest in housing and consumption. Housing is not just shelter, underpins the credit system. When prices stop rising, the wealth effect reverses. Households spend less because they feel poorer. Retail. Sales slow, even as population growth accelerates through immigration. The Canadian dollar faces pressure as rate differentials shift, raising the cost of imported food, energy, and goods. Meanwhile, Canada's productivity growth has stagnated for years, preventing wages from matching living costs. This is the paradox of a developed economy: surface stability masking weak income fundamentals. The middle class doesn't collapse. Overnight it descends step by step, trading quality of life for temporary stability. Government and central bank responses usually arrive after risks have formed. The Bank of Canada prioritizes inflation control, keeping rates high long enough to break expectations even at the cost of short-term growth. This is classic monetary trade-off. Fail to anchor inflation and the currency erodes faster. Governments expand social spending and housing support to ease pressure, but deficits grow as borrowing becomes more expensive. Sovereign CDs levels in developed countries remain calm, but no longer complacent. Greece taught a hard lesson. When fiscal and monetary policy fall out of sync, the burden ultimately lands on taxpayers and the middle class. At the personal level, economic shocks are not felt through theory, but daily choices. Middle-class families scrutinize every bill, compare fixed versus variable rates, delay second homes or vehicle upgrades. Psychological stress rises as asset values no longer offset risk. Mortgage renewals at peak rates add hundreds or thousands of dollars monthly. Personal liquidity becomes decisive. Those with cash adapt. Those dependent on income alone struggle. Argentina and Turkey saw similar patterns, where defensive household behavior weakened domestic demand further. When millions act cautiously at once, the economy enters a slow, deep contraction. Survival strategies in such environments focus on risk management, not fast wealth. Lessons from the IMF era show households fare better by reducing leverage before being forced. In Canada, that means prioritizing liquidity, emergency cash reserves, controlling variable rate debt, diversifying income sources. The middle class is often trapped with wealth tied up in illiquid housing. In high-rate environments, positive cash flow matters more than maximizing returns. Those who adjust consumption expectations early suffer less if the cycle drags on. Greece showed that collapse comes not from lack of assets, but delayed adaptation. In economics, survival always precedes growth. At a deeper level, Canada's middle-class decline is structural, not merely cyclical. Years of growth, driven by housing and credit-masked falling productivity. Without productivity gains, real wages cannot rise sustainably. Venezuela and Turkey demonstrate what happens when economies drift away from real value creation. Canada is far from that edge, but warning signs exist. Reliance on population growth to sustain GDP, while GDP per capita stagnates. The middle class feels poorer because reality diverges from past expectations. The gap between macroeconomic stability and lived stability is widening. When that gap grows, social trust enters its most fragile phase. Economic history rarely repeats exactly, but it rhymes. In every country where the middle class weakened, the same question emerged: temporary adjustment or long-term shift. Canada may avoid Argentina or Greece if it restores productivity, rebalances housing, and rebuilds confidence in real income. But time does not favor delayed reform. Each year of high rates, each month living costs outpaced wages, shrinks the middle class's margin of safety. This documentary ends without certainty, but with an open reflection. When the economy grows on paper, while everyday life tightens, is Canada passing through a temporary hardship or quietly redefining what middle class truly means?